America's motorhome market has officially hit collapse mode.
All right, inflation and rising interest rates are hitting just about everybody.
Sales are down nationwide after a crazy few years.
Sales and rentals are soaring.
Production lines are stalling. Dealer lots look like storage graveyards. Prices are cratering faster than 2008. But here's the real headline. Some of the biggest brands in the industry might not make it to 2026. If they fall, owners aren't just losing value. They're losing warranty safety nets, parts access, and trade-in stability. Most people have no clue the fallout has already started. So which 7 brands are quietly cracking behind the scenes? And who's next? Let's break down the 7 flashing warning signs right now. Coachmen, the mid-tier giant that lost its core. Walk through any dealership lot this fall, and you can spot the Coachmen row without even reading the signs. The paint looks tired, the banners hang low, and the salesmen pretend not to see you coming. For decades, this name stood for steady middle ground reliability. Not glamorous, not cheap, just solid. But that balance has cracked. The very brand built on dependability has become a liability for the same dealers who once swore by it. The shift began quietly after the pandemic surge. Between 2022 and 2025, factory shipments dropped from 34,800 units to just 18,900. That is almost half of the output gone in barely 3 years. Warranty reports climbed by over 62% in that same window, with service centers overloaded and replacement parts on backorder for months. One leaked bulletin from Elkhart used the phrase temporary reimbursement pause. In dealer language, that means you fix it first and wait to get paid later. Costs are what finally crushed the rhythm. Material prices jumped, interest rates climbed past 7.5%, and floor plan loans started bleeding cash. Every unsold Coachman now costs a dealer roughly $320 per month in storage and financing. Multiply that across 100 rigs, and you can see why showrooms are quietly cutting orders. What once brought margin now drains it. For owners, the math looks even worse. Used listings that fetched $52,000 last spring are now closing near $41,000. That is not simple depreciation, it is market rejection. Buyers see headlines about quality issues and walk the other way. And when confidence disappears, resale value follows right behind it. Insiders describe the mood at the Indiana plants as running light. Shifts rotate, overtime vanished, and suppliers have begun demanding faster payments before shipping parts. The brand that once promised stability now feels unanchored, still standing, but uncertain how long the floor beneath will hold. Coachman's story is not over, but it reads like a warning. When a company forgets who it builds for and chases volume instead of trust, the middle ground becomes quicksand. And that lesson leads directly to the next chapter, where prestige, not price, is the problem. Fleetwood, the luxury icon on life support. You can feel the silence before you even step through the gates of Fleetwood's Indiana plant. The air used to hum with drills, compressors, and conversation. Now it echoes. Half the station's dark, half the workers gone. This isn't a slowdown. It's a slow fade of one of the most recognizable names in American motorhome history. Fleetwood once meant craftsmanship. Long before marketing departments started throwing the word luxury at everything with a touchscreen, this brand earned its name through weight, build, and endurance. But over the past 4 years, the costs that built that reputation have turned against it. The company's parent division reported a revenue decline of over 63% between 2024 and 2025. That drop isn't a dip. It's a nosedive through the market floor. At its peak, the Decatur facility employed more than 2,000 workers. Today, insiders describe skeleton shifts, crews reduced to a few dozen per line. One foreman quoted in a regional report said, "We still have the passion, but not the orders." The numbers back that up. Annual production now sits below 5,000 and shrinking. That is the lowest output in more than 30 years. Material inflation hit Fleetwood especially hard. Diesel chassis costs rose 23%. Aluminum framing and composite interiors climbed 12.5%. Every single build became a financial tug-of-war between quality and viability. Rather than compromise the structure, Fleetwood raised sticker prices. A coach that sold for $270,000 in 2021 now lists near $355,000. The buyers, meanwhile, didn't follow. Loan approvals above $200,000 fell across all major lenders, leaving Fleetwood's premium rigs stranded at the top of a shrinking pyramid. Dealers responded the only way they could, shrinking orders, cutting display space, and discounting until profit margins vanished. Used units are now selling at barely half of invoice value. For a brand built on prestige, that is humiliation in real time. Inside Fleetwood, the phrase temporary hold has become routine. But temporary can turn permanent fast. When a company runs out of affordability and patience in the same year, recovery is no longer guaranteed. And that's the quiet warning leading straight into the next chapter, where the budget tier learns what happens when inflation crushes the foundation. If you've seen signs of this downturn where you live, hit the like button so more owners can find this report. Subscribe for updates as this collapse unfolds, and share your thoughts below. Your insight keeps this investigation grounded. Gulfstream, the budget brand. Buried by inflation. Drive past any Gulfstream lot today, and you can see the struggle without needing a sales report. Rows of entry-level motorhomes, lined like still soldiers, price tags rewritten in red marker, and grass growing between the tires. The same brand that once gave first-time families an affordable way into the open road has been cornered by the very force it could never control, inflation. For decades, Gulfstream built its reputation on one promise: value without pretension. The materials were basic, but the design was honest. It was the brand for buyers who wanted practicality over polish. But between 2020 and 2024, that balance snapped. Material costs jumped 44%. Plywood, insulation foam, steel tubing, every input multiplied. Even roof sealants doubled in price. What had been a $30,000 build became $45,000 before a single upgrade was added. The company tried to absorb the shock, cutting overtime and trimming labor across its Elkhart County plants. By late 2025, payroll records showed shifts cut from 3 to 1, and overtime completely frozen. Production slowed to a crawl. Dealers began refusing new allocations, saying the math no longer worked. Each unsold coach now costs around $330 per month in floor plan interest, insurance, and storage. Multiply that by 100 idle units, and the cost reaches $33,000 per month before a single sale. Buyers noticed too. Household savings are down nationwide, and loan rates hovering near 8% wiped out the affordability gap that once defined Gulfstream's success. What was once a reachable dream for working families has turned into a finance headache. The secondary market shows the proof. Used listings from 2023 are down more than 30%, with lenders tightening credit lines and appraisers marking residual values in red ink. Inside the company, morale has dimmed. Workers talk about unfinished shells sitting on factory floors, waiting for materials that arrive too late to matter. Inflation didn't just raise prices, it broke momentum. Gulfstream's decline isn't dramatic, it's quiet, relentless erosion. The kind that eats through trust dollar by dollar. And as that lower tier collapses, the story turns upward, toward the giant whose empire may soon face the same reckoning from the top down. Thor Motorcoach. The empire cracking from within. Walk through the industrial lots of northern Indiana, and you can sense the fatigue inside Thor Motorcoach. The hum of production lines that once defined the American motorhome industry has dulled into an uneasy silence. This was the empire that swallowed competitors whole, a company so large it seemed untouchable. But even giants collapse when their own weight becomes the enemy. Thor didn't grow by accident. It built dominance through acquisition, buying one brand after another until it controlled nearly 40% of North America's motorhome output. For years, that scale looked unstoppable. Investors loved the numbers. Dealers lined up for allocations, but when the market slowed, the math turned brutal. The same mass that powered growth began pulling the company under. In the fiscal third quarter of 2025, production was cut by 48%. Public filings listed an inventory overhang of $312 million. That's inventory sitting idle. Finished motorhomes parked bumper to bumper, unsold, each one accruing interest and storage costs by the day. Two major facilities in Elkhart and Wakarusa reported temporary layoffs, but the reality on the ground felt permanent. Workers described rows of half-built shells and trucks that no longer come to load them. Debt has become the unseen pressure. After years of borrowing to acquire new lines, Thor's total obligation now stands above $4 billion. Rising interest rates have turned that once manageable debt into an anchor. Each percentage point adds tens of millions in cost. Dealers whisper that factory reps are pushing extra inventory to clear space rather than meet demand. One longtime retailer in St. Louis put it bluntly, "They ship faster than we can sell." And the bank calls before the first test drive. Consumer trust has followed the same downward arc. Service backlogs stretch for months, and warranty claims often go unanswered while budgets tighten. Every postponed repair erodes what's left of the brand's credibility. Thor Motorcoach remains vast, but its foundation is splintering. The empire that once grew by absorbing rivals now faces the danger of collapsing under its own scale. And when the pillar of an industry starts to shake, the tremors reach everyone around it, including the next name on this list, the one built on sheer volume and speed. Keystone, the volume king, running out of buyers. In the parking fields outside Goshen, Indiana, the truth about Keystone isn't hidden. It's parked in plain sight. Acres of motorhomes stretch in silent rows, gleaming under the gray sky, waiting for buyers who never showed. This is the brand that once symbolized unstoppable growth. But the crown of the volume king now feels more like a burden than a victory. During the pandemic boom of 2021, Keystone produced over 130,000 units, the largest output in its history. It was hailed as proof that the American road was alive and profitable. 2 years later, those same numbers turned into a liability. Factory projections for 2025 show production closer to 75,000, a drop of more than 40%. The excess sits idle, depreciating before the ignition ever turns. Aerial footage from the company's northern complex shows row after row of unsold inventory, hundreds of millions of dollars in finished goods with no retail path. Dealers call it the graveyard. They aren't exaggerating. One internal bulletin dated May of 2025 admits, "Elevated field inventory remains our core challenge." Translation: the market is saturated and demand has vanished. The used market makes the damage visible. Units that once listed above $62,000 now sell at auction for barely $33,500. That gap has erased confidence across the entire dealer network. Even the most loyal retailers are scaling back orders, afraid of paying interest on stock that won't move. Many now operate with half their normal floor plans just to stay solvent. Inside the plants, morale has thinned. Production runs only one shift per day, and workers rotate weekly to avoid layoffs. Overtime, once guaranteed, has disappeared. Technicians speak of slow builds, not because of care, but because of limited parts and uncertain scheduling. Keystone's crisis is simple but devastating. Too much supply, too little buying power. The same scale that once made it dominant has become a financial trap. When growth is endless, risk hides beneath momentum. Now the momentum is gone, and the weight remains. And as Keystone's volume engine sputters, the focus shifts upward again. To a brand built on prestige, not price. That's discovering luxury can become its own collapse. Before we move into the final brands, make sure you're subscribed. The next segments reveal the largest financial risks in the market right now, and you'll want to be here when the data hits before anyone else does. Rev Group, the collapse that could take others down with it. Every industry has a backbone. In the world of American motorhomes, that backbone has long been the Rev Group. The name might not appear on every coach, but its reach runs through nearly every segment of the market. Frames, engines, and full-size luxury builds all trace back to this network of factories and suppliers. And right now, that network is showing cracks deep enough to shake the entire structure above it. The latest filing with the Securities and Exchange Commission shows the company's recreational division carrying more than $1 billion and $100 million in long-term debt. Revenue has fallen 48% in just 2 fiscal years. Analysts now describe its debt-to-equity ratio as beyond the red zone. In plain language, that means lenders are nervous, suppliers are tightening credit, and every delay risks triggering a domino effect across the industry. Inside the Decatur, Indiana complex, production has slowed to less than 40% capacity. Entire sections of the assembly line sit dark for days because vendors have stopped shipping materials until invoices are cleared. Workers describe shifts where nothing leaves the gate. Coaches half-built, parked, waiting for parts that never come. One welder told a local paper, "We are building ghosts." It's not a metaphor. Those unfinished shells represent millions in tied-up capital and no revenue return. Dealers downstream are already feeling the ripple. Warranty approvals are delayed. Reimbursement programs are frozen. And technical support calls go unanswered for weeks. If Rev restructures, or worse, defaults, those warranties could vanish overnight, leaving thousands of owners without service coverage or replacement parts. The problem extends beyond the company itself. Rev controls multiple premium and mid-tier manufacturers. If one division falls, the rest stumble with it. A failure here would hit suppliers, lenders, and even competing builders who depend on shared infrastructure. Industry insiders quietly call it the Keystone risk. Remove it, and the whole arch starts to sag. Rev Group's crisis isn't just a corporate story, it's a pressure point for the entire motorhome economy. And as those debts mount, the question isn't whether the damage spreads, it's how far it reaches. Because waiting just above this fault line is the biggest titan of them all, one that may be too large to save. Forest River. The titan that might be too big to save. When a company the size of Forest River begins to stumble, the entire map of American motorhome manufacturing trembles. For decades, it was the titan, the builder that touched nearly every category on the road. From compact travel rigs to full-scale luxury coaches, its production scale dwarfed competitors. Backed by the power of Berkshire Hathaway, it appeared untouchable. But the numbers leaking out of northern Indiana tell a very different story. One of strain, saturation, and silent panic. An internal report from late September of 2025 shows Class C output down 37% year over year. Layoffs have already hit both the Elkhart and Goshen facilities, with overtime frozen since June. 2 subcontractors walked away mid-quarter, citing unpaid invoices and delayed reimbursements. Even longtime suppliers, once loyal to the giant, are now demanding faster payments before shipping key components. It's the first visible sign that cash flow, not capacity, is becoming the problem. Dealers are facing their own reckoning. Defaults climbed 29% this summer as unsold inventory stacked up. The company has quietly begun absorbing those stranded units, adding them to its own balance sheet. That means more than 11,000 completed coaches sitting idle nationwide. Every single one represents a floor plan loan, still accruing interest, insurance, and storage fees. At current rates, those carrying costs run into the tens of millions each month. Forest River's business model always relied on volume. Build more, sell more, repeat. That worked when credit was cheap and families were upgrading every few years. Now, that same model feels like an anchor. The sheer number of brands, factories, and overlapping divisions has turned efficiency into overload. Insiders describe management meetings filled with talk of consolidation and streamlined survival. Sub-brands are being merged or quietly erased, all to save what's left of the margins. The warning signs no longer whisper, they shout. A company can only outrun gravity for so long. Forest River still holds the largest market share in the nation, but scale no longer guarantees safety. Even titans collapse when their own size outgrows their balance sheet. And for Forest River, the fall won't be a single crash. It will be a slow, grinding descent that reshapes the entire motorhome landscape in its wake. This market shift is moving fast, and it affects every owner and buyer right now. Drop a comment. Have you seen price drops or dealer panic in your area? Hit like if this helped, subscribe to stay ahead of the collapse, and I'll see you in the next one.